this, I do want to share a few observations here in terms of saying that high frequency indicators, despite India going through the energy spike and the war related uncertainties and the short supplies and stuff, I think consistently in the last 3-4 months, I think our high frequency indicators have kind of kept their chin up, have been reasonably good. I mean, whether you talk about auto sales numbers, you talk about bank credit. So therefore, are you getting a little more confident in terms of how earnings are likely to pan out, say in how are you assessing earnings into the second half of this year? That I think I'd like to understand.
So I think you're right. I mean, I think none of us really expected this kind of resilience of the Indian economy, right? In the aftermath of the Middle East conflict actually breaking out. But I think, and in a way, one is kind of seeing this apparently in certain other economies as well. From whatever little bit I could gather, I think certain other markets are also, I think, kind of facing this crude related issue better. It's also to do with the fact that I think somewhere oil intensity to GDP, I think, has come down, right? In the last 10 years, as per the RBI's own analysis, India's oil intensity to GDP has come down by 1/3 in the last 10 years. And if you take the last 15 years, it is down by a whopping 60%. So I think to that extent, sensitivity has come down. There is no doubt about that. And I think probably that's what is showing up in the way we are able to kind of navigate these kind of tough periods. See, from whatever I think we are seeing from what management commentary is, and what we are seeing from the numbers, how free cash flows are also growing for companies, and how ROEs are also kind of holding up quite well. Leverage is, as we know, at a 20-year low.
At the lowest, I would imagine.
Yeah, and banking balance sheets are good. So I think the setup looks pretty good in a way. And therefore, I think the fact that we've kind of managed this so well seems to be giving more confidence to investors that the rest of the year probably is going to be better. Now, there is the other angle to this also that's playing out, right? And this is a global phenomenon. First, when COVID happened and supply chains got impacted, that's when the whole world woke up and said that we should probably rethink this whole just-in-time principle. And there was a subtle shift away from that.
I think China +1 was probably born out of that.
That is one fallout of that. But this whole thing about and then it got stronger with the Ukraine-Russia related issue, and then of course now. So I think the world has moved from saying that we move away from just-in-time to be resilient, and therefore I think supply chains are getting reconfigured in a way that you're wanting to reduce dependency, and therefore there is a lot more bringing stuff back onshore.
Onshoring, you mean? Okay.
And therefore reducing the dependence of the external supply chains to which you can be suddenly
vulnerable
cut away from. Yeah. So I think is a very big shift that one is actually seeing, and in a way it's actually throwing up a lot more growth opportunities
for India,
for economies, every economy, which is obviously economies are getting more inward looking. Good or bad is a philosophical debate for another day, but then right now it is throwing up a lot more growth for economies, and that includes India as well.